A guaranteed way to improve your trading and increase your win rate is to implement time frame analysis into your trading. This is Time Frame Analysis Level 1 Understanding, Introduction to Multi-Time Frame Analysis and Directional Bias. So what is multi-time frame analysis? Well, simply put, multi-time frame analysis is the art of using different time frame charts to predict market moves based on probability. Why is multi-time frame analysis important? Well, multi-time frame analysis done correctly is what gives us a winning edge in the market. When you combine the understanding of the master pattern, which is key, with multi-time frame analysis, you create an unparalleled understanding of the market that will serve as the baseline platform of your strategy and approach to trading. So it's really the combination of understanding how different timeframes interact with each other and then combining the framework of the three market phases or the master pattern methodology with that multi-time frame analysis. That's really what we're going to get into in this lesson. So I'm going to briefly walk you through an example showing you the power of mixing the master pattern methodology with a higher time frame directional bias using multi-time frame analysis. If you've seen some of my past videos, especially on YouTube, you're going to be familiar with this concept. If you haven't, I'm about to blow your mind. This is an extremely powerful concept. Starting on the left side of the slide right here, you can see that we have some daily candles that are in a confirmed downtrend. Now this is actual price action that we ripped out of the Euro USD daily chart, so you could go look for it if you want to. You'll see there's a white line here. That is what we call ATS Trend. It's one of our proprietary indicators. Basically makes spotting trend direction idiot-proof on our higher time frames. That's what it's there for. Again, you don't need it. You could just generally look at the candle directions and the candle colors and also accomplish this as well. But again, this is just one of our indicators that really makes it easier. So we could see this is clearly in a downtrend. So let's look at some lower time frame price action that happened within this trend. These are 30-minute candles, and you can see that we have two master pattern value points that had formed within the trend on the 30-minute chart. So when we look at the daily, we're going to have what we call a short directional bias, meaning we are only willing to sell the market if the daily is trending downward. When we get a master pattern value point or a contraction zone, that becomes a true market value that we're going to want to trade by. What does that mean? If you look at the red zones on the slide, every single time price action tries to deviate away from fair market value, it's going to return right back to that value point in the higher time frame trend. Why does this happen? Because the stronger money and the more stable money is supporting the higher time frame direction. Looking at the bottom of our slide, as long as the higher time frame trend on the daily holds short, all 30-minute price increases in the red zones return to value. Nothing will continue to trend up as long as the daily holders are supporting the trend. Pairing defined value points with higher time frame momentum is the basis of a very powerful and repeatable trading methodology. This is what we would call our basic strategy, which you'll learn more about. Directional bias. You're going to hear me say that term over and over again throughout this training. Again, what does it mean? Allowing the confirmed direction of a higher time frame to determine whether you are only buying or selling at any given moment. So if you're trading a 5-minute chart for your entry, you're going to be looking at maybe an hour or a 4-hour as your directional bias. If the 4-hour is going up, you are only looking for buy opportunities. If the 4-hour is going down, you're only looking for sell. If you're trading a 15-minute chart, you might want to look at a daily chart. If the daily is going down, you're only selling. If it's going up, you're only buying, so on and so forth. And we could talk more about time frame pairings in a later lesson. So how do you determine your directional bias? Well, there's a few different ways. So the first thing that you could use to determine directional bias is a simple Heikin-Ashi candle indicator. We use this for years, like 10 years. We use the Heikin-Ashi candles just like this. It's a good way to track directional bias, but it does have its drawbacks. The good thing is it gives you a very stable candle color. So that'll cut a lot of noise out of the market. Now the drawback is that you can't see the candle bodies and you can't see the intricate detail in the market. So sometimes if it's a heavy reversal, you could end up taking a much bigger loss than you would want to if you're not paying attention. So They are good in their stability, but they do lag a little bit. There's a give and take there. You'll notice that if you've used our software or you see some of my other videos where I'm showing the software, we came up with a hybrid candle. It uses Heikin-Ashi color, but it uses a standard candle body. This way we could see the intricacies in the candle body, but we still maintain the stability of the color. And we find that that's a great middle ground, and it works really well for us. The second method, which I am not a big fan of, but it can shed some light on general candle direction, is using moving averages, particularly at a tight setting. I don't recommend doing this because of one reason. That's because indicators have settings, and settings can be optimized. Our software, everything that we do, the master pattern itself has no settings. It adapts to all market conditions, and that is key, whereas a moving average does not. But at a tight enough setting, it can give you some general understanding of trend direction and can be helpful with determining a directional bias better than using nothing. Let's put it that way. And the last way to determine directional bias is my preferred way, which is tracking market inefficiencies. So what are inefficiencies? Well, let's start by talking about what is an efficient market. An efficient market is a market where the market makers are able to match up buyers and sellers. And what this traditionally ends up being is a ranging market where you have a lot of overlap, meaning you're going from the highs to the lows, general kind of support and resistance trading. Those are efficient markets. Now, what an inefficient market is when buyers or sellers on the institutional level take over the market and push it into that third market phase, that trend phase, and basically travel from one efficient market, it becomes inefficient and then ends up back in an efficient market. By tracking that gap, that inefficient gap, that shows you the intent of the overall trend and where that trend is likely to fall apart if it goes against that inefficiency. So we like to track those levels, and there's two ways you could do that are very simple. There's a traditional 3-candle separation where you start with a candle, then you have a gap candle, and then a candle below that. Now you can have several inefficient candles if it's a big trend, but this is where it starts, is seeing that little gap between those 3 candles. Now, the second way, which is not widely talked about, is group separation, meaning that the candle that you're on, if you trace it back in all the candles that it has overlapped, or have overlapped it, you can see in that group that it is separated from a particular candle in that group. And that also is showing an inefficiency, but it's very subtle. You have to study and be able to look for that and know what it looks like. What we came up with as a solution to ourselves to find both of these types of inefficiencies and track our trend is that ATS trend line. Again, you don't need our software, but I'm just showing you this is a solution we came up with to make this idiot proof. Basically, the ATS trend tracks the starting inefficiency that kicks off a trend, and then it follows each inefficiency in that trend to show us the exact level. Because when the market trades against an inefficiency in that defined trend, that could be the end of the trend. So we want to know that exact level. And so far, since we've been using this new indicator and doing this, it has been an absolute game changer for determining directional bias. Again, it's basically made it idiot proof. But these are the 3 ways that I would recommend. Of course, the moving averages I would not recommend as much, but it's better than nothing. But particularly Heikin-Ashi candles or tracking inefficiencies, kind of the gold standard. You learn these 3 things, pick one, stick to it, and use that as your directional bias to trade the master pattern methodology in that directional bias. That is a super powerful methodology. So let's talk about all the benefits of adopting a directional bias using multi-timeframe analysis. Number 1, significantly increased probability of winning more trades. Some of these markets, for instance, if you're trading, let's say, a 1-hour chart into a weekly, meaning you're entering and exiting on the 1 hour and you're using the weekly as your directional bias. Go back and look at some of these markets, particularly Euro USD or some of the big Forex markets, and see how many weeks in a row they go in one direction. If you look at some of these markets, they'll go 6, 10, maybe 12 weeks in one direction. If you are trading master pattern framework only in that direction, let's say if it was going long for 12 weeks, that is potentially 12 weeks that you did not have a losing trade. That's pretty impressive. But you'd be surprised at how many people ignore that overall money flow direction. So Again, significantly increased probability of winning more trades. You're going to avoid needless losses. Going along with what I just said, if the money flow is going in one direction, why are you trading against it? There's nothing more frustrating than seeing a mirage, jumping in, trading against trend because you think the trend is over, watching it set up and then blast past you. Not only are you taking a loss, but you're not in the correct trade and you're missing out on an opportunity. So that could be very frustrating. When you adopt a directional bias, that stops. The only thing you got to worry about is the ultimate turn, which normally happens way down the line after you've won so many trades that it doesn't matter when you find the turn. That's the position that you really want to be in. You also get to consolidate focus and effort. If you're unwilling to be a buyer and seller at any given moment, then, for instance, if the trend is going long, you need to focus on being the very best buyer of the market that you can. You can't constantly analyze how I'm going to be a good short seller and a good buyer all at the same time. Why would you divide your effort? If the weekly is going long, only be a buyer on your 30-minute or your 1-hour chart. Lie in wait for the perfect setup on that time frame. That's a way that you're going to compete against the competition, because remember, most of them, 95% of them, are unwilling to do that. That becomes your competitive edge. Next thing is you're going to reduce trading and work fatigue. If you're only willing to trade one side of the market and it's not in a good setup criteria, then you don't need to look at it. Meaning you're going to cut down a lot of the time you're on the screen. If you're always willing to buy or always willing to sell at any given moment, well, then there's always going to be what seems like opportunity to you, and you're going to get tired. So you want to consolidate your effort on high probability quality setups. You're also going to effectively protect and preserve your capital. Again, not being willing to buy or sell at any given moment means that you're lying in wait for that perfect opportunity within your directional bias. Well, you're going to have the capital to maximize that opportunity. That's important. And you're not going to be losing money trading against trend and taking a bunch of trades all the time. So that's going to be very effective for your overall strategy and your overall progress. And you're going to have the potential to leverage up on big opportunities. That's the best thing about trading a directional bias, is because you have so much increased probability of getting in the money on your trades when you're only hitting that direction, that you can actually leverage up your positions a little more and make more for your time. So you can see these are all these benefits really end up being in your favor when you decide to do what the 95% won't and adopt a directional bias. So just hammering home some of the realities of implementing directional bias. I've already touched on some of these, but just want to go through them one more time. The concept of directional bias trading is simple. You have a higher time frame, you only trade in the direction of that higher time frame. It's very, very simple. Yet it's one of the hardest disciplines to master, and that's because most traders cannot overlook the temptation of being in a trade in any direction at any given time. They can't let it go. They cannot deal with the temptation of seeing a move go by in trend and wanting to trade against it because they think this has got to be where the trend's going to end. Most traders give up on their directional bias after only a few losing opportunities or getting caught in actual reversals. There will eventually be a reversal. That's why you need to get in on the move early, which we call grade A or grade B trading. Grade A is that first move out of a turn. Very important. We'll touch on that later as well. This is their fatal flaw and can be your edge if you can commit to this one thing. If you want to not lose like the 95%, do the opposite of what they do. And I'm telling you right now, I know from the data in our prop firm, we see it all the time. This is one of the major things that we have to work with traders in our program, is to get them to give up both sides of the market. You're either a buyer or you're either a seller. The moment that they do that, their results almost instantly and dramatically improve. So what's the takeaway? By committing to one side of the market, you become a much better competitor than others who are unwilling to do the same. Flat out, you're going to compete on a whole nother level because the 95% are unwilling to have a directional bias. Believe it, that's the case. By being open to trading both sides, you limit your effectiveness. No one can pitch and bat at the same time. If you think of baseball, you can't throw the ball and run up and hit it. That's what it means to be a buyer and a seller all at the same time. You won't be able to do it effectively. Knowing the overall direction of money flow allows you to anticipate moves on the lower time frames before they happen. When you have a directional bias, you're going to get a massive increase in your probability of winning trades when you marry that single direction. And the ultimate strategy is trading against traders who are betting against the higher time frame trend. They're going to get mowed down, and you're not, because you're going to be trading with the higher time flow money, which supports the trend. Non-biased traders end up getting caught in false moves that wipe out gains much more often than someone who's committed to a directional bias, going along with what I just said. They're unwilling to trade in trend. If you're simply willing to adopt a directional bias and be absolutely strict to it, you are going to be so much better off. It's going to be so much more forgiving for your entries, and you're going to see a massive increase in your results from this one simple thing.